Gold is one of the rarest metals that humans mine on a commercial scale. Its rarity is one of the main reasons gold has remained valuable for thousands of years. But rarity alone doesn't create a profitable business. To make money, a mining company must extract gold for less than it can sell it. That sounds simple, but in reality, it's one of the most capital-intensive businesses in the world. Before a single gram of gold is sold, companies may spend years exploring land, securing permits, raising capital, and building the mine. Only after all of that can the company begin producing gold and earning revenue. So, how does a company decide whether a piece of land is worth billions of dollars or completely worthless? But before a mining company can earn its first dollar, it must answer one critical question. Is there enough gold underground to build a profitable business? Because finding gold is only the beginning. The real challenge is turning that discovery into a profitable mining operation. Before we can understand how a gold mine makes money, we first need to understand why gold is valuable in the first place. Unlike food or oil, gold has very few essential everyday uses. Yet people are willing to pay thousands of dollars for a single ounce of it. That might seem irrational, but economics provides a simple explanation. The first reason is scarcity. Gold formed billions of years ago through extraordinary geological processes, making it naturally limited. Unlike paper money, no government can simply create more gold whenever it wants. Every new ounce must be discovered, mined, and refined. That makes gold one of the most difficult commodities to increase in supply. And when demand remains strong while supply grows slowly, prices tend to stay high. Every business needs customers, and gold mining is no different. But unlike a bakery or a supermarket, gold mines don't sell directly to everyday consumers. Instead, gold enters a global supply chain. The largest source of demand comes from the jewelry industry. Every year, thousands of tons of gold are transformed into jewelry. For many people, gold jewelry isn't just decoration. It's also a way to store wealth. In many countries, buying gold is considered a long-term investment. Investors are another major source of demand. Some investors buy physical gold bars and coins. Others invest in gold without ever touching a single piece of metal. One of the biggest buyers of gold isn't a person at all. It's investment funds. These funds buy and store massive amounts of physical gold on behalf of millions of investors. This allows people to invest in gold without storing it themselves. Another major buyer is central banks. Countries hold gold as part of their official financial reserves. Gold helps diversify a country's reserves beyond paper currencies. Gold is also used by manufacturers. Because gold conducts electricity and resists corrosion, it's used in many high-tech products. Together, these buyers create global demand for gold. But demand alone doesn't determine how much money a mining company earns. To understand that, we first need to know how a company finds gold in the first place. Every gold mine begins with one simple question. Could there be gold beneath this land? But companies don't choose locations randomly. They begin by studying the geology of an entire region. Certain types of rocks are far more likely to contain gold than others. Millions of years ago, hot mineral-rich fluids flowed through cracks in these rocks. As those fluids cooled, tiny particles of gold were left behind. Today, geologists search for the clues left by those ancient geological processes. They collect hundreds of rock samples from different locations. Every sample is carefully analyzed in a laboratory. Most samples contain no economically useful amount of gold. In fact, the vast majority of exploration projects never become operating mines. If early surveys look promising, the company moves to the most expensive stage of exploration, drilling. Drilling allows geologists to collect long cylinders of rock called core samples. Each core sample reveals what lies hundreds of meters beneath the surface. Most of the core is simply ordinary rock. That means the company isn't looking for solid gold. Instead, they're searching for rock that contains enough gold to be mined profitably. This is where one of the mining industry's most important concepts comes in, or grade. Or grade measures how much gold is contained in a specific amount of rock. A higher ore grade means more gold can be recovered from every ton of rock. That usually means lower production costs for every ounce of gold produced. But if the ore grade is too low, mining the deposit may never be profitable. But having gold in the ground doesn't automatically make it an ore deposit. A deposit only becomes, or if it can be mined at a profit. That's why mining companies care more about economics than the amount of gold alone. One of the most important measurements is called the cutoff grade. The cutoff grade is the minimum amount of gold a rock must contain before it's worth mining. Anything below that limit becomes waste rock, even if that waste rock still contains tiny amounts of gold. Recovering that gold would simply cost more than it's worth. This is the first major economic decision every mine must make. Mining lower grade or increases production, but also increases costs. Mining higher grade or usually produces more gold from less rock. Every mining company constantly balances production against profitability. Once enough drilling has been completed, the company estimates how much gold the entire deposit contains. But it's impossible to know the exact amount before mining actually begins. That's why mining is both a science and a business built on probabilities. Finding gold is exciting, but investors don't invest in excitement. They invest in numbers. Before building a mine, the company must estimate how much gold can actually be recovered. Not every gram of gold underground can be mined. Some deposits are simply too deep. Others are too small to justify the enormous cost of building a mine. Some are located in remote mountains, deserts, or frozen regions where infrastructure barely exists. Building roads, electricity, and water systems can cost hundreds of millions of dollars before mining even begins. That's why geologists work closely with mining engineers and economists. Together, they estimate whether the project can generate a profit over its entire lifetime. This evaluation is known as a feasibility study. It combines geology, engineering, economics, environmental studies, and financial analysis into one detailed plan. Investors read this report before deciding whether to risk their money. A strong report can attract billions of dollars in investment. A weak report can end the project immediately. This is why exploration companies spend years collecting data before making a final decision. Every new drill hole reduces uncertainty, but uncertainty never completely disappears. Mining companies are making billion-dollar decisions based on the best information available, not perfect information. That's what makes mining one of the world's highest-risk industries. Only after the numbers make sense does the company move to the next stage, raising the money to actually build the mine. Discovering a profitable gold deposit is only the beginning. Before a single ounce of gold can be sold, the mine itself has to be built. And building a modern gold mine can cost hundreds of millions or even billions of dollars. Very few mining companies have that much cash sitting in their bank account, so they need outside investors. Investors provide the capital needed to turn an underground discovery into a real business. But investors don't give away money for free. They expect a return on their investment. If the mine succeeds, investors make money. But if the project fails, they can lose a significant portion of their investment. One way mining companies raise money is by selling ownership in the company. This process is called issuing shares. Every new shareholder owns a small piece of the mining company. If the company succeeds, shareholders benefit as the business becomes more valuable. But selling more shares comes with an important trade-off. Every new share reduces the ownership percentage of existing shareholders. This process is known as shareholder dilution. That's why companies can't keep issuing new shares forever. Instead, many companies borrow money from banks. But unlike shareholders, banks expect every dollar to be repaid with interest. That means the mine must generate enough cash to cover both operating costs and loan repayments. If gold prices fall too much, repaying those loans becomes much more difficult. That's why banks carefully study every mining project before approving a loan. A single mistake in these calculations could cost lenders hundreds of millions of dollars. Once financing is secured, construction begins, but the mine still hasn't earned a single dollar. Production only begins after years of planning, construction, and testing. Every day, thousands of tons of rock are moved using some of the world's largest machines. But not every truck is carrying valuable ore. Geologists decide which rock becomes ore and which becomes waste using detailed geological models. After leaving the mine, the ore is transported to the processing plant. The first step is crushing the large rocks into much smaller pieces. Those smaller rocks are then ground into a fine powder to expose tiny particles of gold. Grinding increases the surface area, making it much easier to separate the gold from the surrounding rock. But the gold is still mixed with tons of crushed rock. To recover the gold, mining companies use a series of chemical and physical separation processes. The most common method is called cyanide leaching. The cyanide doesn't melt the gold. It dissolves it into a liquid solution. Once dissolved, the gold can finally be separated from the waste rock. Even after all this processing, no mine can recover 100% of the gold. The recovered gold is then melted inside a furnace to remove the remaining impurities. The result is a door bar, a mixture of gold and small amounts of other metals like silver. These bars are shipped to specialized refineries for further purification. Refineries increase the purity to investment-grade gold, often reaching 99.99% purity. Only after this stage is the gold ready to be sold on the global market. Selling gold brings in revenue. But revenue is not the same as profit. Every ounce of gold has a production cost. Mining companies call this the all-in sustaining cost, or AISC. Investors closely watch AISC because it shows how efficiently a mine is being operated. If gold sells for $2,000 an ounce, but the AISC is $1,700, the mine does not keep the full $2,000. A higher gold price only creates more profit if production costs remain under control. So if mining costs stay relatively stable, what actually determines whether a gold mine earns more money next year? The biggest factor is the market price of gold. But unlike most products, gold isn't priced by mining companies. Gold is traded globally, meaning every producer sells into the same international market. That means a mine in Australia, Canada, or South Africa all respond to nearly the same gold price. So what actually causes the price of gold to rise or fall? Like every market, the gold market is driven by supply and demand. If demand grows faster than supply, gold prices usually increase. And when supply grows faster than demand, prices usually fall. But gold is different from most commodities because investment demand plays a much bigger role. One of the biggest drivers of gold prices is inflation. Inflation reduces the purchasing power of money. As money loses value, many investors look for assets that can preserve their wealth. That's why gold is often called a safe haven asset. During periods of economic uncertainty, demand for gold often increases. Another major factor influencing gold prices is interest rates. Unlike a savings account or a government bond, gold does not pay interest. So when interest rates rise, many investors move their money into interest-paying assets. That often reduces demand for gold. And when interest rates fall, gold often becomes more attractive again. Gold is also closely linked to the strength of the US dollar. That's because gold is priced in US dollars around the world. When the dollar becomes stronger, gold becomes more expensive for buyers using other currencies. As demand weakens, the price of gold often comes under pressure. But when the dollar weakens, gold becomes more affordable for international buyers, often increasing demand. Central banks are some of the largest buyers of gold in the world. They don't buy gold to make jewelry. They buy it as part of their national reserves. Gold helps diversify a country's reserves instead of relying on a single currency. When many central banks increase their gold reserves, global demand rises. And when gold prices rise, efficient mining companies can generate much higher profits without increasing production. A high gold price does not guarantee a profitable mine. Every mine has different operating costs. Some mines also produce much lower grade ore, making every ounce more expensive to recover. Rising fuel prices, labor costs, and electricity costs can quickly reduce profit margins. That's why the most successful gold mining companies focus on controlling costs, not just producing more gold. In the end, a gold mine isn't simply selling gold. It is managing risk, costs, and capital every single day. Every decision, from exploration to refining, affects whether the company creates value or destroys it. That's why investors don't just watch the price of gold. They also study how efficiently each mining company operates. The companies that control costs, allocate capital wisely, and adapt to changing markets are the ones that succeed over the long term. Gold may come from the ground, but the real profits are created by economics, finance, and smart business decisions. Surprisingly, most of the gold ever mined in human history still exists today. Unlike oil or coal, gold is rarely consumed. It simply changes owners. That means almost every ounce of gold ever produced can still influence today's market. Understanding gold mining isn't just about geology. It's about understanding how economics, finance, and global markets work together. Thanks for watching. If you enjoy learning finance through simple animations, subscribe for more.